Let's welcome in Ethan Harris, head of global economics for Bank of America Securities. Ethan, it's good to see you. And a hike a meeting. Why is this still something, sort of a tightening campaign that you think should last for quite some time and not be phased by anything from the Ukraine war to the sort of, weaker than anticipated retail sales report this morning to everyone's concern about a slowing economy?
Well, let's be serious here. I mean, what central bank would have a zero funds rate with an 8% inflation rate and an unemployment rate dropping as fast as the U.S.? Instead of talking about rate hikes in the last few months, the Fed should have started the rate hikes. I don't understand what they're waiting for. So they are behind the curve. And I think that the way this Fed will act to catch up is to do it in a very choreographed, careful fashion. And so the easiest path for the Fed going forward is to hike 25 basis points at each meeting. Then from the market's perspective, it becomes kind of an ongoing process. There aren't a series of shocks. It's just a continuation of what they started. I also think from a political point of view, it's easier for the Fed to be on a regular diet of rate hikes rather than vacillating back and forth between hiking and pausing going into an election. They don't want to look like they're pausing or speeding up around the election. They want to look like they're on a path of regular hikes. So I think it makes a lot of sense for them to hike at every meeting until they get a much more clarity about whether inflation's coming down or not.
And Ethan, so obviously you're more in the camp of expecting a hawkish hike here. Explain what else that could look like with everything from the projections to the rhetoric that Chair Powell uses next hour.
Well, they have to revise all their forecasts. Things have changed a lot since December. They've got a very low inflation number. They've got only 3 hikes penciled in for this year. I'd be amazed if they only hike 3 times this year. So they've got to raise those numbers. The unemployment forecast they have is also stale. They're saying that the unemployment rate, which has been dropping, it's dropped to almost 1.5% in the last 6 months. In their forecast, it suddenly levels off. It only drops from 3.8 to 3.5% over the course of the whole rest of this year. So they need to lower their unemployment rate forecast as well. So the revisions to their growth, inflation, and Fed call or forward guidance has to be significant. On the other hand, I do want to point out the markets have this misconception that the Fed wants to go fast out of the gate and then slow down later. And I don't think that's consistent with their message. The markets are still pricing in a good chance of a 50 basis point hike at one of the next 2 meetings. I don't think they're going to do that. They're going to start at 25 and then think about 50 later.
Oh, interesting. So start slow and then maybe pick up momentum, especially if we get some clarity on geopolitical events and otherwise. Ethan, great to have you on. Appreciate the words of, I wouldn't say warning, just some context around the headlines we might be getting. Thank you again.